Hello everyone, John AG here, and I need you to buckle up because the silver market just flashed one of those signals that makes seasoned traders sit up straight, stop scrolling, and ask an uncomfortable question. If silver is supposedly plentiful, why are the places that are supposed to be stuffed with it quietly getting emptier while the price is ripping higher? Because that's exactly what the numbers are hinting at right now. And if you're only watching the spot quote on your screen, you're missing the real story. The real story is in the drains, the delays, the out-of-stock pages, and the strange behavior that doesn't line up with a normal, healthy market. So in this video, I'm going to walk you through what's happening, why the paper price can fall in seconds while physical supply tightens for months, how arbitrage pressure is building between different regions, and why a shortage at today's prices looks unsolvable. And just before we get into it, I have to say this politely but clearly. My channel stats show that a big chunk of the people who watch these videos haven't subscribed yet. If you get even a little value from this kind of breakdown, hit subscribe right now. We're pushing for 50,000 subscribers in the next 30 days, and your click makes a bigger difference than you think. Also, we're now posting members-exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build these deep dive updates only for you, our special members, and the John AG family. If you want in, click the join button right now, or use the link in the description. All right. Now let's start with the part that should make you raise an eyebrow. Imagine you're watching an asset climb hard. Not one of those sleepy moves, but a real surge. Now imagine that at the same time, the largest, most visible vault inventory tied to that asset is dropping. Not rising, dropping. That combination is weird. It's not what you expect when investors are piling in. Because normally, when everyone is excited, inventories swell. Vaults fill. The system attracts metal. But what we're seeing is the opposite pattern. A noticeable decline in reported vault stocks, while share prices linked to silver exposure have been climbing sharply over the same window. That's not a clean speculation bubble signal. That's a someone needs metal signal. And here's the uncomfortable twist. The people with the keys to those vaults aren't typical retail buyers. They're the institutions that operate the plumbing of the market. The ones who can swap paper for bars in large blocks. The ones who have access you don't. So when those vault numbers slide while price rises, it suggests something else is happening behind the scenes. Metal is being pulled, not added. Now, a lot of people who aren't deep in silver see a big run and immediately shout, "Bubble, it's going to collapse." And sure, in many markets, that's a reasonable first reaction. But that reaction assumes the move is driven by hype. This move looks different. It looks like a move driven by stress, and stress looks like fear, not greed. Stress looks like people trying to secure supply before someone else does. Stress looks like buyers paying up in one part of the world while another part is still pretending the price is calm. And that brings us to the global picture. Because the silver market is not one single room with one single price, it's a web of regions, exchanges, refiners, and delivery chains. And when one region starts paying materially more than another region for the same physical metal, the market tries to fix it through arbitrage. That's the invisible hand people like to talk about. But here's the catch. Arbitrage requires transport, logistics, time, and most importantly, available metal. And when availability is tight, arbitrage becomes slow and messy. It doesn't instantly close the gap. It pulls on supply like a vacuum, and that vacuum pressure shows up as shortages in places that used to feel comfortable. Right now, one of the most important signals is the premium being paid in certain physical markets. When you see a triple-digit equivalent price in one major hub, while the Western benchmark is sitting materially lower, that gap is not just a curiosity. It's a giant neon sign saying, this metal is worth more here, right now. And if that premium persists, it creates a simple incentive. Move bars toward the higher price. Over time, metal migrates. That's what markets do. But while that's happening, something even stranger is showing up in the Western financial products. Reported metal associated with a major silver ETF has been declining even as the share price has surged. Think about that. If the share price is up big, that should attract more participation. Yet the metal line is going the other way. So how can that happen? The answer is in the mechanics most people never bother to learn. Authorized participants. These are large players who have the ability to create and redeem shares in big baskets. They can hand in a chunk of shares and receive physical bars, or deliver bars and receive shares. That mechanism is supposed to keep the ETF aligned with the underlying metal. But in a shortage environment, that mechanism can turn into a drain. If someone needs physical bars badly enough, and the ETF structure offers a way to extract bars by tendering shares, you can see metal leave the vaults even while retail investors cheer the rising share price. And no, most normal holders can't just call up and demand a bar. The structure isn't designed for that. which means the retail participant is often the last person to know what's happening until the available supply suddenly isn't available. Now, should that worry someone who holds a paper proxy for silver? It depends on why they hold it. If you hold paper because you want price exposure only, you may not care about delivery. But if you hold paper because you believe it is the same as owning metal, then you need to pay attention. Because in a stress scenario, the difference between exposure and possession becomes the entire game. And this is where people get emotional, because the system was built to feel safe. It was built to feel liquid. It was built so you could click buy and sell without thinking about bars, pallets, vault doors, and refinery schedules. But the physical world has limits. And when the physical world hits limits, the paper world can get violent. That's why you see days where price gets slammed down out of nowhere. It's why you see sudden drops that don't match the demand story. It's why you can watch silver fall quickly and then climb right back, because the underlying pull for physical doesn't vanish just because someone hit a sell button. In fact, one of the most common moments for this kind of smackdown behavior is around option expiry. Options are leveraged bets. They are essentially time-boxed claims on direction. And when a lot of options are stacked up, certain players have a strong incentive to nudge the market in a direction that reduces their payout. So what do? They sell into the market. They push prices. They try to scare weak hands. They try to compress volatility at exactly the moment it hurts the most people holding those leveraged contracts. And if you've watched silver long enough, you know the routine. A sudden hit, a wave of panic commentary, and then the market tries to recover as real demand reasserts itself. Now here's the cliffhanger you need to sit with. What happens when these smackdowns stop working? Because if the physical shortage keeps intensifying, price suppression becomes harder to maintain without bleeding metal. At some point, the paper trick meets a physical wall. And when a market meets a physical wall, the moves can get historic. Let's talk about the supposed hedges and why people argue endlessly about whether big banks are safe. You'll hear claims like, they're short here but long there, or they run balanced books, or they have offsetting positions. And on paper, those statements can be true. But the real question is not whether a hedge exists on paper. The real question is, can the hedge deliver? Because a hedge that can't be settled in the asset you need is not a hedge, it's a promise. And in calm times, promises trade like assets. In stress times, promises trade like liabilities. There's public reporting that gives at least one window into positioning in certain futures markets, and it indicates that major dealer categories have carried meaningful net short exposure. The exact numbers move around, but the point is simple. The paper market has been built on large, short positions that assume the system stays liquid. Now, if you believe a major hub for spot contracts becomes unreliable for timely delivery, what happens to the idea of, I'm hedged? Your long is only as good as the ability to convert it into metal when you need it. So if the delivery chain gets delayed, stretched, or clogged, the hedge becomes less comforting. And that's when stress compounds. And stress is exactly what we're seeing in the supply chain. Because we're hearing about mint products being limited, large bars being unavailable from certain sources, and dealers seeing extended delays, sometimes even cancellations. Not everywhere, not all at once, but enough to paint a pattern. And patterns matter more than headlines. Here's a key point most people ignore. Even if there is a large amount of silver above ground in total, the market doesn't care about total above ground in a crisis. The market cares about deliverable form. 1,000 ounces of silver in the wrong shape, in the wrong location, or in the wrong hands is not the same as a 1,000-ounce bar sitting in a place that can satisfy an exchange delivery requirement. That's why refining and converting capacity becomes a choke point. You can have silver somewhere and still have a shortage here. You can have silver in jewelry, industrial components, private hoards, or dispersed stockpiles, and still have a shortage of exchange-eligible bars. And if the refineries that can convert that dispersed metal into deliverable bars are already running around the clock, you're staring at a bottleneck that money alone cannot instantly fix. A refinery can't be willed into existence overnight, and a smelter can't be built in a weekend. So if demand is rising faster than the system can convert and deliver, you get exactly what we're seeing. Pressure, premiums, delays, and a growing sense that the shortage at current prices does not clear. Now let me pause right here and ask you two questions, because I want you in the comments. First, do you think the market is being driven more by speculation or by fear of not being able to get silver later? Second, if silver is truly plentiful, why are the big pipes of the system showing stress, delays, shortages, and draining inventories? Drop your answer below. And if you've had any real-world experience trying to buy physical, delays, premiums, substitutions, tell us what you saw, because those on-the-ground stories help everyone. And speaking of stories, if any of you are doing well, if you've had a win, a breakthrough, a smart move that worked, Share your success in the comments. Seriously, your story can lift someone else's morale more than you realize. Now, there's another piece of this that people keep misunderstanding. It's not just about mining more. Yes, production matters, but production isn't a faucet you can turn on when price spikes. Mining is slow. Permits are slow. Capital cycles are slow. And silver is often mined as a byproduct, which means its supply responds differently than a pure primary metal. So when someone asks, how long until supply catches up? The honest answer is, not quickly. There may be stocks that can be mobilized at the right price, but moving those stocks into deliverable form still takes time, processing, and infrastructure. And in the meantime, demand can increase again. That's why you can have a shortage that looks impossible at one price and only becomes solvable at a much higher price. Because at higher prices, new supply gets coaxed out of hiding, old stock comes to market, scrap flows increase, substitution attempts happen, recycling ramps. People who never planned to sell suddenly consider it. But none of that happens instantly. And as long as the price is held below the level that clears the market, the physical squeeze can intensify. Now I'm going to say something that might make some viewers uncomfortable, but it needs to be said. The more the system interferes with price discovery, the more violent the eventual adjustment can become. Because if you suppress signals, you don't eliminate reality. You delay it. You store it. You build pressure behind a dam. And when the dam leaks, the early signs look like random volatility. But when the dam breaks, the move looks like a reset. This is why you're hearing people throw around huge silver price numbers. Not because anyone can predict an exact target, but because a market that snaps from paper confidence to physical panic does not move in polite increments. It gaps. It overshoots. It forces repricing. Now, I'm not here to give you a magic number. That's not the point. The point is to understand the mechanics so you can see the direction of stress. And the mechanics are screaming one thing. Physical silver is being chased. We've seen it in premiums in key regions. We've seen it in reported vault drains. We've seen it in mint constraints. We've seen it in dealer delays. We've seen it in the way price gets smashed and then tries to recover, as if there's a deeper bid underneath the market. And we've seen it in the way mainstream commentary often latches onto technical indicators that may not matter in a regime shift. Because when a sea change begins, old tools can mislead. In a normal market, RSI, moving averages, and short-term momentum signals can help. But in a structural shortage, those indicators can scream overbought, while the physical reality screams not enough. And if you've ever watched a real squeeze in any market, then you know the feeling. It's the feeling of looking at the price and thinking, this shouldn't be possible. And then it becomes possible anyway. Now let's talk about the retail side, because retail is where the story becomes personal. Retail buyers are often the first to experience unobtainable conditions, not because they're less important, but because they don't have priority access. Governments, big manufacturers, and large financial players can often source metal before the average person can. So as supply tightens, retail products go first. Bars vanish, premiums jump, delivery times stretch. Some dealers begin quoting pre-order dates that used to sound ridiculous. And sometimes the market gets so strained that orders get canceled, not because the dealer is evil, but because the dealer can't source inventory at the promised terms without taking a loss. That's when you realize how different physical is from paper. A paper product rarely cancels your order. A physical supply chain sometimes has to. And when that happens, confidence shifts. People who used to be fine with paper start thinking, maybe I should hold some directly. And that thought, multiplied across enough people, changes the market. Now, I want to be very clear. This channel is not telling you what to buy or sell. You make your own decisions. But what I can do is explain why the system is behaving strangely and why that strange behavior matters. Because if you understand the why, you won't get shaken out by the emotional whipsaws. And speaking of whipsaws, you're going to see more battles at key moments, option expiries, futures roll periods, and major liquidity windows. Because that's when pressure points are easiest to exploit. If the paper side needs to defend itself, those are the days you'll see the most dramatic moves. But here's the question. How many times can you defend with paper while physical keeps draining? At some point, you run out of slack. At some point, the market demands a clearing price. At some point, the metal stops being a line item and becomes a scarce object again. And when that happens, you don't get to buy it like a normal consumer product. You get to compete for it. Now, there's another angle we need to talk about because it's happening quietly. Banking behavior. We are hearing stories of banks getting uncomfortable when clients make large precious metal purchases. And whether every story is true or not, the concept itself tells you something important. Physical metals are a threat to a leveraged system. Why? Because metal held outside the system reduces the system's control. It reduces fee streams. It reduces the ability to rehypothecate and stack claims. And if you believe that, then a shortage environment becomes even more sensitive because demand isn't just, I want a return. Demand becomes, I want an exit. And exits accelerate stress. Now let me drop a quick creative detour because I promised you this and it matters. If you want silver-related success stories, real people, real moves, real lessons, there's a link in the description to another channel. Go subscribe over there too and see how people have been making money and building positions in ways you might not have considered. All right, back to the main thread because this is where the story tightens. When a physical shortage builds, the key question becomes, what fixes it? There are only a few mechanisms. One, demand collapses. That can happen if the economy breaks, if industrial use falls, or if people stop caring. But the demand we're talking about isn't just industrial. It's monetary demand driven by distrust and debasement concerns. That kind of demand doesn't vanish easily. Two, supply surges. That's hard in the short run for all the reasons we covered. Three, price rises enough to ration demand and mobilize supply. That's the classic clearing mechanism. Higher prices discourage marginal buyers and encourage marginal sellers. If you believe the first two are limited, then the third becomes the default outcome over time. And that's why people say insoluble at current prices. Not because the universe will run out of silver, but because at today's price, the market is not clearing the metal that is needed in the forms and locations that matter. Now, you might be thinking, okay, but what about the huge amount above ground? And yes, there are estimates of massive totals across all uses. But here's the catch. If that silver is distributed, embedded, or psychologically locked up, it does not act like supply. And when the market senses that, it starts paying premiums to coax supply out. It starts offering higher bids. It starts pulling inventory from wherever it can. Which brings us back to the vault drain and the ETF mechanism. Because if large participants can extract bars there, they will. And every ounce pulled is an ounce not available for another purpose. So the question becomes, are we watching a quiet transfer of silver from visible pools into less visible hands? Because if we are, that changes the future. It changes who controls supply. It changes who can deliver when needed. It changes the entire balance of power. And that's why this is bigger than a chart. It's bigger than a candle pattern. It's bigger than a daily RSI reading. It's a structural story. Now, let me take you one layer deeper, because if you're still thinking this is just a price rally, you're going to miss the part that can catch people off guard. Silver is not only a precious metal, it's also a critical input. It sits inside electronics, energy systems, medical tech, and industrial processes that don't pause just because a chart looks overbought. That means you have two forces pulling on the same limited pool, monetary demand and industrial demand. And when those two forces pull at the same time, the market doesn't behave politely. It behaves like a crowd pushing toward a single, narrow door. At first, everyone thinks they can get through. Then someone stumbles. Then the door jams. And suddenly the problem isn't, what's the price? The problem is, who gets in? This is why I keep coming back to availability as the real signal. Because availability is the thing the paper market can't print. If a contract exists, someone can create another contract. If a share exists, someone can create another share. If a promise exists, someone can create a louder promise. But a bar is a bar. A bar has weight. A bar has a location. A bar has custody. And a bar can only be in one place at one time. So when you see signs that bars are being pulled from the most visible pools, it means the crowd is pressing on the door. Now, some people will say, but the system is designed to handle this. And yes, in theory, the system is designed with buffers, refineries, warehouses, delivery schedules, and settlement rules. The problem is that those buffers were built for normal conditions, and we are not in normal conditions. When the world runs years of loose monetary policy, then piles on debt, then watches consumers strain, then watches governments scramble, it changes behavior. People stop trusting the long chain of promises. People start moving toward tangible assets. People start moving toward ownership that doesn't depend on a third party's solvency. And once that psychology spreads, it spreads fast. It's like a rumor that becomes a stampede. You don't need everyone to panic. You only need a small fraction to demand the real thing. Because the system is leveraged. And leveraged systems don't break slowly. They break suddenly. Now, here's a detail that gets ignored. When deliverable metal tightens, the exchange doesn't just run out in a dramatic movie scene. Instead, it shows up as friction. First, delivery times get longer. Then, product selection shrinks. Then, premiums widen. Then, you see more substitutions. We don't have that bar, but we can offer this coin. Then, you see more pre-orders. Then, you see cancellations. And then, one day, you see the phrase everyone dreads. We cannot source supply at this time. That's not a theoretical sequence. That's how shortages look in real life. So if you're waiting for a single headline that says, silver is gone, you're waiting for the last chapter. The signal comes earlier, in the friction, and friction is building. Now, when you hear refineries are running 24/7, it sounds dramatic, but it also makes sense. If you have above-ground stock sitting in one form and demand in another form, you need conversion. But conversion has capacity limits, and even if you could magically build more refining capacity, you still need feedstock, logistics, quality control, and time. This is not an app update, it's metallurgy. So the next cliffhanger is this. What happens if conversion capacity becomes the true choke point? Because if the world has metal dispersed across many forms but can't convert it fast enough into deliverable bars, the exchange-facing shortage can persist even if total silver sounds large. And if that shortage persists, premiums don't just stay high, they can become the new normal. Now, let's address the comment you're going to see everywhere. If the price goes up, people will sell and the shortage will end. Yes, higher prices can coax selling. But here's the catch. Not all holders are price sensitive. Some holders are trust sensitive. If someone bought silver because they distrust currency, a higher fiat price may not tempt them to sell. In fact, a higher fiat price might confirm their thesis and make them hold tighter. So the supply that comes out at higher prices may be smaller than people assume, especially if the buying wave is driven by long-term fear rather than short-term profit. And that's why this can become a self-reinforcing cycle. Higher price signals scarcity. Scarcity increases fear. Fear increases demand. Demand drains inventories. Drained inventories increase scarcity. You see the loop. Now, there's another angle. Industrial users don't buy because they want a great entry. They buy because they need supply to keep production running. If you're a manufacturer and you can't secure input, you lose revenue, you lose contracts, you lose market share. That's existential. So when industrial users get nervous, they don't wait for a pullback. They secure what they can. And that can change the demand curve quickly. So if you've been wondering why this move feels relentless at times, that's part of the explanation. It's not just traders, it's users. Now, I want to talk about something that sounds boring but decides everything. Settlement integrity. A financial market works as long as participants believe settlement will occur as expected. If they believe a contract equals delivery, confidence stays high. If they believe delivery might be delayed, limited, or replaced with cash, confidence starts to crack. And confidence is the foundation of the paper market. Once confidence cracks, people don't just ask for better prices. They ask for better terms. They ask for allocation. They ask for segregated custody. They ask for direct possession. And those demands shift the game from price discovery to scarcity discovery. That's a different game entirely. Now I'm going to share a practical mindset that can help you avoid getting played by the noise. In any tight market, the loudest voices will try to anchor you to yesterday's reality. They'll say, it can't do that. They'll say, it always reverts. They'll say, the market makers control it. And yes, control exists until it doesn't. Control exists until the cost of control becomes too high. Control exists until the physical constraints force a repricing. So instead of asking, can they push it down today? Ask, what does it cost them to push it down? If pushing price down requires bleeding deliverable metal, then every smackdown is a trade-off. It's a delay tactic. And delay tactics work until they run out of time. Now let's bring this back to you because the entire point of this channel is to help you think clearly, not emotionally. If you're building a long-term position, the day-to-day smash doesn't matter as much as the structural trend. If you're trading short-term, then yes, the smash matters, but you have to respect the calendar. Expiry windows, liquidity windows, and the moments where the market is most vulnerable to engineered volatility. Either way, the key is not to confuse the screen with reality. The screen is the narrative, reality is the bar, and reality is where the stress is showing. If you already have a physical position that meets your personal goals, the best move might literally be to stop staring at every tick. The daily noise is designed to mess with your emotions. If you haven't met your goals yet, then you need to pay attention to availability, not just price. Because in a shortage environment, price is only one dimension. The other dimension is whether you can actually source what you want, when you want it, at a premium you can live with. And yes, the situation can be metastable, meaning it looks stable until one input flips it into dysfunction. That input could be a delivery failure, a refinery outage, a surge in industrial demand, a geopolitical disruption, or a sudden wave of monetary fear. You don't need to predict which spark hits. You just need to understand the woodpile is dry. And if you've ever watched a market go from normal to broken, you know it happens faster than people expect. That's why you're seeing weird dealer behavior in certain regions, extended delays, limited product lines, and sometimes "we'll refund you" messages. Those are not normal features of a liquid market. Now, I'm going to bring this home with something very practical. If you support this channel and want us to keep doing deep analysis, there are 3 things you can do immediately. 1. Subscribe. Again, we're aiming for 50,000 subscribers in the next 30 days, and it blows my mind that so many people watch and don't subscribe. If you value the work, join the community. 2. Check the description for the bonus links. The premium WhatsApp channel link is there, and the channel membership link is there. Use them if they fit your style. 3. Consider becoming a channel member because we're offering members-only videos too. We have a separate team working on those, and they go deeper with more research and more structure. Those videos are designed specifically for premium members who want the extra layer. And while you're down in the comments, I'll ask you again. If you're successful, share your success with us. Tell us what worked. Tell us what lesson you learned. Keep it friendly, keep it honest, and you might help someone avoid a costly mistake. Now, let's end on the big picture because this is the part people will remember. A market can tolerate a lot of paper games when physical is abundant. But when physical becomes scarce, paper games become dangerous. Because scarcity exposes leverage. Scarcity exposes promises. Scarcity exposes the difference between I own it and I have a claim on it. And if this physical shortage continues to intensify, the market will eventually demand a new price that reflects reality. Not a price that reflects comfort. Not a price that reflects tradition. A price that reflects scarcity. So, watch the premiums. Watch the reported inventories. Watch the dealer delays. Watch the refinery bottlenecks. Watch the moments when price is smashed and then rebounds as if someone is desperate to buy. And most importantly, don't let the noise distract you from the signal. Because if the signal is right, the next phase of this story won't be a gentle climb. It will be a reset. And when that happens, the people who prepared calmly will look like they had a crystal ball, even though they didn't. They just paid attention to the mechanics. Leave your thoughts below, hit subscribe, check the bonus links in the description, and I'll see you in the next video.